As a real estate investor, understanding the right metrics is crucial for making informed decisions and maximizing returns on investment. Welcome back, Loopers. I'm your host, Andrew Chung. In this video, we're delving into the top 12 metrics every real estate investor should have in their toolkit. These figures will not only guide your investments, but also maximize your returns. First up is the return on investment, or ROI. As an investor, this metric gives you a snapshot of your property's financial health. ROI measures the profitability of an investment against its cost. And for real estate, it can vary. For residential properties, the formula to calculate ROI is net profit over total investment cost times 100. The key is to factor in every cost, from the purchase price to the maintenance costs. For commercial spaces, it's a tad different. Here, we're looking at net operating income over the total investment cost, again multiplied by 100. The net operating income represents the revenue generated from the property after accounting for operating expenses like utilities, maintenance, and property management fees. Why is ROI so crucial? Well, if you're torn between two investments, ROI can be your deciding factor, helping you see which one might be more profitable. Remember, while ROI is crucial, don't let it be your only deciding factor. Always consider other aspects like location and market trends. Next on our list is the gross rental yield. Think of it as a quick way to gauge your property's rental income potential. The formula? Gross rental yield equals annual rental income over property value times 100. A higher yield is a promising sign, but always dive deeper. Third on the list is the net rental yield. It's like the gross rental yield, but adds in those pesky expenses. The formula? Net rental yield equals annual rental income minus annual expenses over property value times 100. Always compare gross and net yields to see the real expense impact. Number 4 on the list is vacancy rate. It's all about occupancy. The formula? Divide vacant units by total units, then multiply by 100. A high rate may flag potential issues, leading to potential income loss, while a low rate suggests stable demand. Fifth on the list is real estate appreciation rates. Real estate appreciation can be a gold mine. A $200,000 property appreciating 20% in 5 years? That's a $40,000 profit. But always research historical appreciation trends to make educated predictions about the future. Keep in mind market research, location, economic factors, and long-term vision, and seek professional advice. Number 6 on the list is cash flow analysis. Cash flow is the heart of your investment. Positive cash flow? You're in profit territory. Negative? It's not always bad, but be cautious of prolonged periods. Number 7 on the list is the capitalization rate. The cap rate gives you the profitability potential by comparing net operating income to market value. Simply divide the NOI by the property's current market value. Number 8 on the list is the debt service coverage ratio. Want to know if rental income covers debts? That's where the DSCR comes in. Divide NOI by total debt service and you're set. Number 9 on the list is average days on market, or DOM. Paying attention to DOM can help you gauge the overall health of the real estate market in a certain location. A low DOM? Properties are flying off the shelf. A high DOM? Buyer's market and negotiation time. Number 10 on the list is the price to earnings ratio. It's like comparing the sticker price to what's under the hood. PE is the property's market price over the NOI. Low PE might mean a bargain, but do your due diligence. High PE indicates the property's market price is relatively high compared to its income. Number 11 on the list is the real estate turnover rate. No one likes a revolving door. The turnover rate shows how often tenants change. High turnover can dent your profits. Turnover rate is calculated by dividing the number of tenant move-outs during a specific period by the total number of units in your property. And finally, the 12th item on the list is real estate leverage. Leverage is like a magnifying glass for your ROI, but more reward can mean more risk. Always strike a balance. That's a wrap on our top 12 metrics. For more data-driven insights and industry trends, or to learn more specifically about DoorLoop, click on the link in the description below. Well, that's it for this video. Make sure to subscribe and give this video a thumbs up so we can get this information to more real estate professionals. If you want to join a community with other real estate professionals, join our exclusive Facebook community with a link in the description. And to learn more about property management tips, click this playlist here. We'll see you there.